I'm gonna start. Cool. Yeah, so if you could just give like a brief kind of like intro of yourself and background, and then we can, I think, dive into it.
Yeah, maybe I should stop sharing so you can see my face to start. I don't know how. What do you? We'll do this,
Yeah,
but
that's
um, but yeah, guys. So background. My name's Hart Lambur. I graduated Columbia in 2005. Studied CS. Fun fact. In 2005, when I graduated, I think my computer science class was like 50 people. Which I don't think is true anymore. Alex, what's the CS class size now?
I'm sure it's at least 500.
Yeah.
Probably amongst the two schools, probably more.
So there's that. That's different. Other fun fact is that when I graduated in 2005, Google's office, I wanted to get a job in technology. Google's office was 126 people in Times Square, and all but two of them were salespeople. There were only two engineers. Um, and so I'm actually Canadian, and in order for me to get a job and live and work in New York, which I wanted to do after graduation, I had to get a visa from one of the big banks. And I ended up getting a job at Goldman Sachs, an internship there, and then realizing I didn't want to do the technology stuff there. So I got a job on the trading side. And so I was a fixed income trader at Goldman for 8 years from 2005 until 2013. Is this what you're looking for, Alex, in terms of
Yeah,
background?
yeah,
Yeah,
perfect.
cool. And then I left in 2013. I started a fintech business, sort of a wealth management business called OpenFolio that I actually started with my Columbia classmate, Inan Ravid. And we did that together. I did that for about 4 years, and it got acquired by an asset manager in New York in 2017. And then I went deep down the crypto rabbit hole. Well, I already had been, but I went full time down the crypto rabbit hole in 2018, really with a focus around this like intersection of computer science, economics, game theory, finance. And this was before DeFi was a thing or a concept. Basically, realizing that using smart contract platforms to write financial contracts felt like a useful thing. Yeah.
Great. Thanks so much for the intro. Yeah, I think you could, yeah, just go ahead and
So yeah, Alex, I'll do a screen share. I don't think this is a 45-minute
no
presentation.
worries. Yeah, we can have
I want
just
to keep it kind of like, yeah, more higher level and just give you an overview of kind of like why I think, frankly, why I think DeFi is important and some of the concepts that we're working on. And we can keep it really conversational. If people actually want to ask questions in the chat, I can even answer them in real time, and then we can do like some Q&A at the end. Does that work for you?
yeah, sounds great.
All right, awesome. Hold on, where? There we go. All right, so here's my take, guys. So contracts, financial contracts are the backbone of all of finance. This is like my starting thesis. Backbone of all of traditional finance. And this is really obvious when you think of things like futures contracts or derivatives, where these are like very much just legal contracts between an investor and an exchange, an investor and a bank. Insurance is a very pure form of a financial contract between an individual and an insurer. But my general point or thrust here is that the history of financial products and financial innovations has been up to now like all written through legal contracts. It's like new legal inventions that have enabled all these financial products and services. And what's really interesting about like how all these contracts work in TradFi is they're all based around this concept of identity and legal recourse. So if a contract is broken, if somebody doesn't make good on the promise of their financial agreement, whatever it might be, you know who broke it, and you have recourse to fix it by suing them. And this general concept has worked really successfully in the last 100 years in the Western world. trying to let us invent all of these financial products and services. What you've seen with fintech is, I think, software making this process more efficient, making all of these financial legal agreements more efficient, more accessible, easier to use, but still the fundamental enforcement mechanism that actually powers all of these financial products and services is legal recourse. So what's wrong with that? There are some real limitations here, where traditional financial contracts are, number one, not global at all. Legal contracts require you to have an identity within that legal jurisdiction. And my favorite example of this is Robinhood is only accessible to US users, despite massive demand for it in Canada, UK, Australia, China, whatever, it doesn't matter, all those other places. And why can't Robinhood, top tier fintech company, why can't it be accessible in those other places? Well, there's no enforcement mechanism between Robinhood and its users. Robinhood would have to recreate everything it's doing, because it's based around the US legal system to enforce everything they do. The second limitation on all of these TradFi financial contracts are these really high barriers to financial product innovation. And in traditional finance, creating a new financial product is just expensive. So, for example, I've been told by people that have tried to start a mutual fund, you need $100 million of AUM in order to do this. And where I'm going to go with this, right, is DeFi now means you can, in your college dorm room, actually come up with a new financial product and service. So what is UMA doing here? What is our role here? We are a system to enforce financial contracts between anonymous counterparties. So it's an alternative contracting mechanism that builds on top of Ethereum and DeFi. And the idea here is that unlike traditional legal contracts all being enforced by legal recourse, let's figure out a way to write financial contracts that are enforced by the Ethereum blockchain or other smart contract platforms, plus economic incentives that are going to compel users to do what they say they're going to do. And what we're trying to enable, and again, this is very true for DeFi more broadly, we're trying to enable truly global finance. So we want to enforce, we want to allow this alternative contracting system. It doesn't matter your legal identity, that doesn't even exist. Instead, anyone with access to an internet connection and digital money can access this financial system. And two, we are lowering the barriers to actually innovate or create new financial products. It becomes cheap and easy, the thing you can do in your college dorm room. So how does it work? There's a lot of moving pieces here, but the thing we've kind of stumbled upon for our use case, and we can back up here, where first of all, Ethereum or smart contract platforms allow us to figure out logic, where you can deterministically follow logic, if this, then that. But if I'm going to write a financial contract that depends on other real world data, other events, other things that are off the blockchain, we fundamentally come across this Oracle problem, did this thing happen? And what we have stumbled upon is this concept of what we call an optimistic oracle that we can use to ask any question. And I'll get into this in more detail. But in essence, what we want to be able to do to write any type of financial contract, we have an Ethereum blockchain that can do all the if this, then that logic. And we have this optimistic oracle concept that we can ask any deterministic question to when we need information that's not already on a blockchain. And the way this optimistic oracle works, pretty simple. We enforce things optimistically. We assume that contract participants are going to follow the rules, since breaking the rules is costly. And let's just give a really simple example. Say Alex like wants to ask, is on a crypto system, wants to ask a question, what he can do is say, hey, what is the price of gold at this time? Or did this event happen? This like insurance payout happen? Did a hurricane hit Southern Florida? Or you can do it for cross-chain transactions. Did this event happen on layer 2, a layer 2 roll-up? Whatever it might be, he can ask that question to this optimistic oracle. Somebody can respond to that question with a challenge period. And provided nobody disputes their answer within that challenge period, that question is taken as truth. And in the happy path where there is no dispute, everybody moves on, life is good, we've got our answer, all is good. In the unhappy path where there's a dispute, then and only then do we escalate that question to a broader consensus mechanism. And this is our whole voting system, the whole UMA token holder voting system, to get dispute resolution on how that should work. And if you think about what this looks like, this optimistic enforcement actually looks a lot like how contracts are enforced in traditional finance. In traditional finance, Alex and I could write a legal agreement, and we enforce that optimistically. We hope that we're not going to have to sue each other. We hope that we follow the terms of the agreement, and suing each other is the dispute resolution layer that we escalate to if we fail to agree on terms. And we're basically just copying that same sort of concept, but making in a crypto or blockchain native way. So stupid example, simple example. Alice and Bob, it's actually funny. I made these slides a while ago and Bitcoin was a little bit lower. But Alex and Bob want to make a bet on whether Bitcoin is going to be above $10,000 at the end of the year. How do we enforce this contract? We can write this like logic very simply on a blockchain. Here's what the bet is. Here's the terms. They could both lock money to make their payouts. It's an easy thing to do. The example is that we enforce it optimistically. If Alice and Bob at expiry agree on the outcome, if they're both like, hey, yeah, you're right, Bob won, we don't need to do any other work. We're done. Our contract is done and settled, and we can move on. It's only in the unhappy path where they don't agree that we need to escalate that dispute to another system to achieve consensus on who's right. And this is something that we call like our priceless philosophy, where if we can, where Oracle calls really should only be disputes. We should really only use them when there's a disputed outcome. And if we can then minimize disputes, we can minimize Oracle calls. And this makes for a much more efficient, much more scalable, and actually more secure DeFi system. And the optimistic Oracle does just that, where we ask questions, we propose answers. Questions can be any type of data, any type of action or event that's deterministic. And provided nobody disputes them, they get taken as truth. So it's this very flexible framework that allows us to generalize, like in a very general way, write contracts that can reference anything. Started talking about some of this already. So what does this allow? This allows us to ask questions on anything. This is like, why are we able to do this? If you think about how some other Oracle systems work, like take like a chain link style system, we're gonna have a consensus mechanism that's gonna record an outcome repeatedly and publish it on chain. And that's actually very useful for things like getting the price of Ethereum or the price of Bitcoin on the blockchain. Those are things that, like, I think it's actually quite useful to have a record of that. But if you wanted to ask a question that's not very standard, something that is more specific to, say, an agreement that Alex and I made, it'd be really expensive to be constantly reporting that on chain, and it doesn't scale. So the power here is that this optimistic oracle concept, by flipping things into this challenge response game, you actually lower the cost. You make this a much more scalable system where you can go ahead and have agreement in the optimistic case, which happens 99% of the time, and you only need an expensive consensus mechanism if there is a dispute. And the example I wrote here is, let's say that Alice wants to write a contract that pays Bob if the TVL in her protocol breaks $100 million. If we used a kind of on-chain price data oracle, we would have to be paying to update the TVL of her protocol every period of time. It's like a lot of computations, a lot of work. And frankly, like, blockchains are expensive. It'd be really costly to keep writing that data all the time. But if we use the optimistic oracle, it's actually really easy. We just wait until somebody says, yep, TVL now exceeds $100 million. As long as nobody disputes it, we're done. And so it's a much more simple setup to ask more bespoke, more long tail, or more customized questions. So in terms of getting usage, what Uma did with this concept is we've been focused for a while on synthetic assets. And the thought process here is that, like, what I'm kind of describing of like this of using writing financial contracts on anything, that design space is absolutely massive. So in order to prove out the technology and infrastructure, in order to prove out this optimistic oracle concept and the dispute layer that it goes up to, we decided to focus on synthetic assets, which I define as ERC20 tokens that are self-custodied and freely traded. So create a token that tracks anything. And the way to think about this is the token is just a representation for a counterparty in agreement that's going to get a payout at some time or event. And we've been using the optimistic oracle concept and the underlying like concepts here to prove out how flexible and how broad this infrastructure is. And so what can you build here? And I'm going to get through these slides pretty quickly, and then we can ask lots of questions. The thing that we've had a lot of traction on recently is this concept called KPI options. Oops, sorry. Like to zoom out for a second, there's this interesting thing that's happened in the last year and a half, is that DAOs have become a thing, and they went from being a conceptual idea a year and a half ago to now having like treasuries with billions and billions of dollars. And one of the things that seems very obvious that DAOs want to do is use those assets as collateral. They want to use them for things without directly selling them. Because if you just sell them, you just dump on your market, on your token, and it's not good for anybody. But using that asset as collateral in a synthetic asset, in another token that has some payout if some event happens, is something we've seen a lot of traction with. And so this KPI option idea is this idea that a DAO can take a chunk of their own treasury and use it to mint a synthetic token backed by their treasury token that will pay out if some good things happen. And so a typical example could be like, okay, if our TVL goes up to this number, everyone that holds these tokens is going to get a payout. And what is so cool about that is you are creating an incentive structure that aligns like the individual best interest with the collective best interest of the protocol. So every individual that has now one of these KPI options really wants the core metric of the broader protocol to also succeed. And so a lot of projects have been using this concept to play around with incentive structure alignment. And one project that just released this KPI option is this project PiDAO, that is sort of an index fund for assets, and they want to incentivize users to stake their tokens. And they did this by saying, hey, we're going to give all of our early stakers this KPI option that if we achieve our goal, you're all getting a bonus, basically. And we've seen this in a few examples. It's surprisingly effective because now all of your early users become promoters who are marketing and pushing and advocating for the kind of collective outcome. Another thing, a related thing that we've seen traction with is something we call success tokens. And this is really a structure where we're trying to help DAOs raise money from investors, from venture capitalists, but without doing the current design pattern of selling tokens at a discount. And so it's worth like going a bit deeper on it, where what's the use case here? You have a DAO that has a bunch of tokens. A venture investor wants to invest in them, but they can't write a legal contract because the DAO has no legal entity. It's a crypto-only thing. What the current pattern has been is the investor says, hey project, I want to buy your tokens at a 30% discount, and I'll lock my tokens up for 2 years. And I don't have any problem with that, but well, I kind of do. The communities around these tokens all think that that's like really shitty. Like, why is this investor getting this discount? And so what we realized we can do with the synthetic asset is we can actually create a more structured agreement that says, hey, you know what? Let's not have the DAO sell tokens at a discount. Let's instead have the DAO sell tokens at market prices, but give this investor an option, an out of the money option that will pay out if good things happen. And it could be like price goes up. So if the investor helps the project succeed by whatever that success metric is, that investor is going to get an added bonus or added payout. And we can structure this as a synthetic token that ends up looking like a crypto native way of writing a financial contract between an investor and a DAO. And we think that's kind of cool. And then I've listed a few other examples here of some of the other synthetic tokens that have been created with this infrastructure, including like things like UGAS, which was a token to hedge prices of gas. You could ETH gas prices. People have created various covered calls or various option structures. Again, the success token almost looks like a token plus a call option. One of the things that I think is pretty cool is like being able to bet on BTC domination, like what percentage of the market is Bitcoin or like versus altcoins. Very early on, someone created a token that tracks the price of Bay Area real estate. And generally speaking, it's just this very flexible contracting language that we can use to write or create financial contracts that track anything. And guys, this is all I've got in terms of my very short little prepared slides. But I was hoping we could do a few Q&A type questions. And also my Twitter handle is Hal2001, which also happened to be my Columbia Kerberos ID, which all my computer science professors quite liked. So I don't know, it's kind of cool, but yeah.
Great. No, that was great. I just have one question, and then we can, and anybody else wants to chime in, you can either raise your hand or drop it in the chat, and I can read it and Hart can answer. And so for some for those KPI options, so like let's say the actual like say the target of the contract is something that's not quote unquote like on-chain verifiable, then how does this type of like optimistic process work in that sense? And then kind of a related question is, how do you actually prevent collusion, like in general in the like UMA protocol? Because obviously I mean, at least to me, there seems to be some like attack vectors there. when during the dispute process?
Yeah. So what I didn't get into in this, Alex, is like what happens when you escalate a dispute,
Yeah.
which is like really important here. I didn't because it's a long conversation. I wanted to keep this a little bit more high level. But
Mhm.
the core thing here is like, okay, so what the optimistic oracle is an escalation game that says, hey, as long as we agree, as long as we agree on what the outcome is, as long as nobody's proposing bad data, as long as nobody's attempting to lie, um, we're all good. And we're in the optimistic case, we're in the happy path. And what we want is to make it be expensive to lie, like expensive to lie and make it kind of pointless. And so the example is like, think about a perfect, like think about it in the legal system. If you had a perfectly written contract that was perfectly clear on what the outcome should be, and you had an uncorruptible judge, then in theory, nobody would litigate each other. They'd
Yeah.
never sue each other because like you all know the outcome in the first place.
Hmm.
So to your examples, it's like if you ask the optimistic oracle like a badly defined question, or you lie or whatever else, it all means like what the answer is like, well, what happens next? And so disputes in our system get bubbled up to what we call like our DVM, basically to the UMA token holders.
Okay.
And we built this like really fun or really interesting game theoretic game that's a Schelling point based like voting system
Okay.
where token holders that vote correctly get paid a reward, and token holders that don't vote correctly don't. They get penalized. And what correct here means is voting with the majority. So we get into this really fun game theory, and I can give you guys a bunch more slides and really fun math. But the really fun game theory, the concept is we make it so that everybody in the system has to agree on an outcome, and the only outcome that makes sense to agree on is the truth. That's the Schelling point.
Mm.
And Vitalik actually blogged about this, wrote about this, and heavily inspired what we're doing way back in like 2015, something like that. And this Schelling point voting system means that token holders are now incentivized to vote for the truthful answer because they want the rewards, and they're penalized for deviating. They don't get paid. And then we went ahead and we built in a whole bunch of economic guarantees where we can actually prove that it is unprofitable to even attempt to corrupt or bribe the token holders. This goes back to your kind of collusion point.
Mhm.
Actually, do you want to get into that more, or do you want to?
Yeah, I mean, I guess like one fault. So like that makes sense to me, but on this other like the same, but kind of related there. Like if you like, I don't see why it's not, because like the profitable thing is to vote for what's correct, but what's correct is not, doesn't necessarily have to be true. It's just what the majority is voting. So it is kind of this like economically weighted votes. So I don't like I understand like I see how it's like a collusion proof in that sense, but then like can't people just be voting for the wrong thing?
So yeah, it's actually a really interesting way of phrasing it. Like, how do you get a group to agree on what like the right thing is? This is the game theory behind it,
Yeah.
where what you're saying is you're saying I'm going to pay you to vote for the majority. The majority has to be right here.
Yeah.
And how do you get the majority to align on the right outcome?
Mhm.
Well, it turns out if people vote in secret, right? So you don't know how somebody's voting. So part of what's core to this is a commit reveal scheme where voters have to commit their votes and then they reveal them later on. If people vote in secret and you can't see how other people are voting, and you can't even trust, like they can't tell you how they're voting either, like they can't lie to you. So what ends up happening is the only answer that makes sense for people to vote on in secret is the answer they think to actually be true. And that means the Schelling point, the commonality is like, okay, well, I got to vote for the truth.
Got it.
um, So it's really fun.
That's interesting. But so for this like voting in secret though, how is that actually? I assume like the final vote's published on chain so people can verify it. Like how is that? Sorry, this is kind of like a technical question, but I'm just curious. Like how's that actually done?
The
Is
fun.
there like there's like a centralized aspect to it where you're collecting these private votes and you reveal it publicly, or
No, it's two steps. So voters have to actually commit their vote, like encrypted on
okay,
the chain, and then they have to reveal it as a second step.
got
And
it.
so it's like a two-step voting process for that reason, um, which frankly is like kind of annoying because voters have to do two things, but it's core to the game theory of it.
Yeah.
There's actually some ways of thinking about gasless voting, and I don't know if you guys all want to come join our team, and we've got some fun solutions there that work on, but there's maybe trade-offs to it. So
Very
yeah.
cool. Yeah, no, that makes a lot of sense. Thanks. I think we have some questions in the chat if you want to answer any of them.
Yeah, so let's go. So like when outcomes are not clear, this is like the perfect question. Like if a security did something actually trade at a given price? This is actually the core reason why I think this type of voting system is critical to the long-term security of DeFi. So let's just say, to make the example a bit clearer, let's pretend there's like a flash crash. So you've got the price of Bitcoin. Let's just say the price of Bitcoin staying around 60K. And then there's some flash crash to 50,000, 55,000 somewhere on some exchange. Is that a valid price or not? Right? Like should a liquidation happen at that price or not? It's actually unclear. What do centralized exchanges do? Centralized exchanges like the CME will actually take flash crashes and they may break trades. Like if somebody, they may break trades, they may like undo them if they determine that it was irrelevant, it was bad price action, bad trade. And that's an example of what TradFi can do because of recourse. They can actually undo things. With my approach and my philosophy is that disputes here are actually necessary so that if there is price action that some people disagree with, you can actually escalate it and ask this committee, which happens to be all these token holders in this game theory, who's right. And what you want to specify up front is the conditions under which one side should be right or not. Like, hey, when do we think a flash crash is real? If it's reported on one exchange but not others, how much volume has to trade there? You should kind of have a sense for what that is up front. But generally speaking, human judgment is actually what you want. And I think at the end of the day, you need some concept of being able to appeal, to escalate things to a sense of human judgment and human consensus as to whether outcome A or B should be true. Does that make sense? Keith, did I explain that? Keith's question, but yeah, cool. Okay. Then Clark asked a question, what do you do in the situation where the majority is wrong? And his example was like before 2009, majority of people probably would have thought that a negative interest rate from a central bank was impossible. I think that's not the types of questions that I think are useful here. And it's like not predicting whether something in the future is possible or not. It would be like, are interest rates right now negative, or has there been a negative interest rate? That's something more deterministic rather than like predicting the future. Would kind of be my answer. That like you can't really ask a committee to predict the future. You don't want to ask a question to predict the future. You could say, hey, right now in 2007, do the majority of people think this is true or not? Maybe that makes sense. But otherwise, you have to you'd have to be more specific. And then Andy asked a question, regulatory concerns. I mean, like financial contract, the way I look at all this, the way I look at all of DeFi is we were writing financial contracts. It's a different contracting mechanism. Some of the contracts that are getting written really don't have a good analogy to traditional regulatory structures. Some do. You know, you could write a DeFi contract that looks identical to an insurance contract and it fits in an insurance like regulatory framework. But it's like, I'm personally, and what our project is more interested in is the actual contracting mechanics. How do we make this thing work? And we're trying to build this infrastructure that people can use, the developers or other entities can use to actually write these contracts. And we're trying to stay distant from the regulatory concerns right now because it's very unclear. What else do we have here? Keith also asked if the voters in the system are the nodes. They're actually the token holders. Keith, if you want a really, really bizarre analogy for how our actual escalation game, like our actual dispute resolution mechanism works, so the UMA token holders, you can almost think of it like a human blockchain, where when votes happen, when a dispute happens, we ask all our token holders to write down and like come to consensus through this voting process what the answer is. And that process takes 2 days. So it's almost like there's a 2-day consensus. It's like we mine a block every 2 days that we ask voters what the answer is. But those are the nodes that are, these are the entities that are achieving this consensus. And then Yuli asked a question around, let's see here, creating contracts with real world events, such as like hurricane insurance. How does verification of real world events through an unbiased intermediary work on the protocol? I'm not sure I think what you're kind of getting at is like, how do you know if like that insurance should get paid out or not? And again, this is where we're appealing to kind of like human consensus here. So you got to start with trying to specify what would the conditions of payout happen. Like the clearer the agreement is, the better. Just like with a traditional legal contract, the more clear it is, the more obvious what the outcome should be. And then it's really the edge cases that should be handled by human judgment. But this is the stuff that's like, we'll get there. We'll get to those more discretionary things. It's easier, and like where we're starting is things that are easy to verify. Like, you know, did this event happen on this other chain? Did this TVL metric get hit? That kind of stuff.
So like in the end, this escalation mechanism, isn't Oracle actually called to then get like the truth, or the actual like truth doesn't really matter? It's basically like the outcome of this kind of game theoretic procedure.
So I think what I'm getting, so the optimistic Oracle is this like escalation game between that you hope you never go past. You say you hope you never have to escalate. And then if you escalate it, we go to this the UMA token holder game theoretic voting system that takes 2 days to go through. And wait, did that keep going, Alex? Ask your question again.
Oh no. So I was just asking, so like, do you have the kind of like UMA token holders that are voting in this mechanism if you do escalate it through like a dispute mechanism? But my question is like, so let's say it's a price, like, are you actually verifying that in the end through calling some Oracle, or it actually doesn't matter? And
it's
then like
literally gonna, it's literally gonna be like, so if you want to, let's be a concrete example. Alex, you want to ask for the price of some weird metal, let's say tungsten or something, at like today. You know, Solana's doing their like tungsten cubes or whatever. So you want to ask for the price of tungsten, and you ask, and the optimistic Oracle, somebody responds, but then somebody else disagrees with that response. They say, no, that's wrong, right? Then it gets escalated to the UMA token holders, who are all going to vote. They're actually going to input what they think the price is. I think the price is, you know, 1,000. And then there's a consensus mechanism from them about what that price is, and that's the answer. Does that make sense?
That okay, got it. But basically, like but you're still able to essentially make like priceless contracts where there's no introduction of any oracle ever to verify,
The
or is
price,
that kind of like
the yeah, the priceless thing might be like us being a little cheeky, where the price like the we've never called an oracle unless there's a dispute. The
okay,
optimistic oracle we're saying isn't actually an oracle, like it's
okay,
not
okay,
doing any
I see, I see.
consensus. It's like a
Okay,
little, maybe it's a little bit cheeky of us to say that, but
yeah,
the optimistic oracle means like, hey, we're gonna ask for a price, someone's gonna optimistically report it. There hasn't been a consensus mechanism, an expensive consensus process,
got it.
right? And there won't be unless somebody disputes it.
I see.
And then Cesar asked if how we weight votes. It is one token, one vote. There would be really interesting like future ideas about quadratic voting and stuff like that, but there's lots of like civil problems around that. All right. Well, Keith asked a question: what if token holders don't know the answer or just don't respond? That's the game theory and incentive. So first of all, in all of these things, in all of the questions that can get asked, there's also an ability to respond like that's a badly formed question, or like that the right answer could be like there is no answer to what you're asking, is one thing. And then Keith, if you don't participate, you lose out on rewards. That's the whole incentive structure behind this. So, and the rewards that you get for participating if other people don't participate go up. Like you get you would get, it's like this, a fixed amount of rewards are paid per vote to whoever participates. So if fewer people participate, it's actually better for those that do.
How do you, but there is a risk in actually participating though. Like if you participate and you vote for the wrong thing, you do get it's almost like it's like a kind of not slashing, but you do get penalized, correct? Or you just don't get
You
rewarded.
you don't, but like these are economically equivalent, Alex, like
Yeah.
to be kind of clear, like if you're being economically efficient and you're like, okay, my ownership of the network, right, if I don't participate, my ownership of the network shrinks, so I'm getting penalized.
Yeah.
They are like economically equivalent. So yeah, the answer is we really want the whole thing here. This is why this isn't meant to be like passive. Like you're not supposed to be a passive holder of this token. The idea and is like you've got to be active and you got to be right, otherwise it hurts. And that's kind of part of the whole mechanism here. And by the way, this is the shit that's really fun when it comes to designing protocols, designing token systems and all that. This isn't like a security like stock that just pays a dividend. Like no, we're like, hey, this is a whole different thing. The rules of the game here are you got to vote and you got to vote right, otherwise it hurts. And then Cesar's asking if large holders have a disproportionate weight in defining what the truth is. I mean, they are weighted by their token stake. That's also part of like the core economics, where if they are effectively risking more because they own more of the network. And if the network ever fails, the tokens they own should become worthless. Like that's the other thing. We could go much more into the game theory of this, but there's a big threat that if it turns out that this token voting system doesn't work, then it means the token you own is garbage. If it doesn't work, it goes to zero. So it's like the more tokens you own, the more personal capital you're putting behind believing that this system is going to be truthful. And so that economic stake really matters in ensuring that you actually get to the truth. Yeah. So last thing I should say, guys, because you know I like Columbia students, like, and we are hiring too. So, and not only are like we hiring for our own project, but we know of the other teams in New York or elsewhere, and really want to like. I do think this is a great industry to suck a lot of the talented folks at Columbia into. So please do ping me on Telegram, on Twitter, or email like hello@inmoproject.org, yeah, for if you're interested in like getting in the industry.
Great. Thanks so much, Hart. This was super interesting. Thanks for asking all the questions too. I think this was kind of the perfect mix of like presentation, but then actually also like Q&A. So that was great.
Thanks, guys. Really pleasure talking with you.
Thank you.
To